Support and resistance are not lines on a chart. They are the memory of every trader who has ever bought or sold at that price. When a stock fell to $48 6 months ago and bounced, a crowd of buyers stepped in at that level. They remember it. If the stock pulls back to 48 again, those same buyers are watching. New buyers see the prior low and see value. Short sellers see risk. That concentration of attention at the specific price is what creates support. Resistance works the same way, in reverse. The stock ran to 62, then sold off. Everyone who bought near 62 is either break-even or underwater. When price returns to 62, they sell, relieved to get out. That selling pressure is resistance. This is not technical mysticism. It is crowd psychology operating on price. AI cannot draw these levels for you in real time, but it can help you identify where the meaningful levels are, assess how strong each one is, and build a complete trade around what happens when price arrives at that level. That is what this episode covers. The mechanism behind support and resistance is not the line itself. It is what the line represents. Every price level that has been significant in the past left behind a group of traders with unfinished business. Buyers who got in at support and held on are watching their entry point if price returns. They add, buyers who missed the original entry now get a second chance, and they take it. Short sellers who were wrong at the lows are nervous. They cover. The same logic applies at resistance. Sellers who shorted at the highs are watching their target. Buyers who bought near the highs are holding a loss, and when price returns, they exit to break even. New short sellers see an opportunity to sell into strength. What makes a level significant is not how many times an analyst has drawn a line through it. It is how many people made decisions at that price, and how many of them still have positions tied to it. The more traders with memory at a level, the stronger the level. Not all support and resistance levels are equal. 3 things determine whether a level deserves your attention. Number of touches. A level that has been tested and held 2 or 3 times is significantly stronger than one that held once. Each successful test adds confirmation. More traders mark it. More algorithms anchor to it. Volume at the level. High volume at a price level means more shares changed hands there. More traders have their cost basis anchored to that price. A low volume bounce creates a weak level. A high volume reversal creates a strong one. Recency. A level from 3 weeks ago is more relevant than one from 18 months ago. Recent levels have more active participants who remember them. Old levels still matter, but they carry less weight unless they also show heavy historical volume. When all 3 align, multiple touches, heavy volume, and recent, that level is worth building a trade around. 2 categories of levels deserve special attention: round numbers and prior swing highs and lows. Round numbers 50, 100, 150, $200 act as support and resistance because human psychology anchors to them. Limit orders cluster there. Earnings targets reference them. Option strikes are set there. The level works, partly because enough participants believe it will. Prior swing highs and lows are the most reliable levels on any chart. A prior high marks the exact price where sellers overwhelm buyers. A prior low marks the exact price where buyers overwhelm sellers. When price returns to either level, the same dynamic that created the original turn is likely to repeat. When a prior high is broken and price pulls back to it, that old resistance often becomes new support. When a prior low is broken, that old support often becomes new resistance. This role reversal, support becoming resistance and vice versa, is one of the most tradable setups in technical analysis. Prompt 1. maps the significant support and resistance levels for a stock. Use this prompt. For the stock ticker, analyze the price chart over the past 60 to 90 trading days. Identify the 3 to 5 most significant support and resistance levels. For each level, specify the exact price range of the level, whether it is currently acting as support or resistance, the number of times price has tested that level and held, any notable volume spikes associated with that level, and whether this is a prior swing high or low, a round number or a consolidation zone. Rank them by significance, with the most relevant level for a trade in the next 5 to 10 days listed first. What you get back is a structured map of the price landscape, not a guess. A ranked list of where buyers and sellers have historically made their stand. When reviewing the output, focus on 2 things. Cluster zones, not exact prices. Support and resistance rarely holds at a single number. It holds within a range, often 1 to 3% wide. If the output identifies a level at $84, think of it as an 83 to 85 zone. Price rarely turns at the exact number twice. Role reversals. If the output identifies a prior resistance level, that price has recently broken above. That level is now candidate support. These converted levels are often the strongest setups because 2 separate groups of traders are anchored to them. The original sellers who set the resistance and the breakout buyers who bought the break. If the output gives you 5 levels, focus on the 1 or 2 closest to current price. The most relevant level is the next one price is likely to encounter. Prompt 2 evaluates how strong the nearest level actually is. Use this prompt. For the stock ticker, the nearest support level is approximately price from prompt 1. Please assess the strength of this level using the following criteria. How many times has price tested this level in the past 60 days, and did it hold each time? What was the approximate volume on the day's price touched this level? Was it above or below the 20-day average volume? Is this level also aligned with a moving average, a round number, or a prior swing high or low? Has this level previously acted as resistance and converted to support, or vice versa? Based on these factors, rate the level strength as strong, moderate, or weak, and explain the primary reason for that rating. Strength assessment before entry is not optional. A weak level breaks. A strong level provides the foundation for a trade. 3 outcomes come out of prompt 2. Strong level. Multiple touches above average volume at each test, aligned with additional technical factors. This is worth building a trade around. Your risk is defined. Stop goes just below the level for a long, just above for a short. Moderate level, 1 or 2 touches, mixed volume. Tradable but with smaller size and a tighter stop. Do not expect the level to hold on first contact. Look for a confirmation candle before entering. Weak level, single touch, low volume, no alignment with other technical factors. Skip it. Wait for the next significant level identified in prompt 1. Never build a trade around a weak level. The math does not work. A weak level breaks more often than it holds, and a broken level does not give you a clean stop. Prompt 3 constructs the complete trade around a tested level. Use this prompt. For the stock ticker, current price is price, and the nearest support level is rated strong or moderate at approximately level price. Build a complete trade structure, the entry, whether to enter at the level on first touch, wait for a confirmation candle, or enter on a break and retest. The stop loss placed just beyond the level where the thesis is invalidated, specifying the exact price. The first target, the next resistance level above for a long, or next support level below for a short. The reward to risk ratio at those parameters. The time frame, How many days before this setup either works or is reassessed. Only present the trade if the reward to risk ratio is at or above 2 to 1. Entry at the level. Stop beyond it. Target at the next level. That is the entire structure of a support and resistance trade. Support is not a line. It is memory. Every significant level on a chart has the same origin. A crowd of traders who made decisions there and are watching to see if it holds again. When price returns, so does their attention. That attention creates the buying or selling pressure that makes the level hold. The 3-prompt system gives you a repeatable process for finding and trading these levels. Prompt 1. Map the levels. Identify the 3 to 5 most significant support and resistance zones within 60 to 90 days, ranked by relevance to the current price. Prompt 2. Assess the strength. Multiple touches, high volume, alignment with other factors. These separate the levels worth trading from the ones worth skipping. Prompt 3. Build the structure. Entry at the level. Stop beyond it. Target at the next level. Only take the trade if the reward to risk clears 2 to 1. Next episode, sector rotation. How institutional money moves through the same sectors in the same sequence every single cycle, and how to position ahead of it. See you Monday.